Hello everyone. In today's video, we're going to break down some important updates and insights around NIO that have recently surfaced. I've organized today's discussion into 7 main points, each of which carries its own weight in understanding where NIO stands and why certain decisions are being made right now. By the end of this breakdown, you'll have a clearer picture of the logic behind NIO's latest share offering, the strategic timing, and what it means for both short-term and long-term investors. This is not financial advice. Please do your own research. Let's start with the first point. NIO recently announced the issuance of 182 million new shares. This is a huge move, and many people have been watching closely to see how it unfolds. Based on the timeline, the closing of this offering is expected either today or tomorrow. This isn't something vague, it's imminent. Whenever such a large volume of shares is involved, it naturally draws attention because it directly influences dilution, ownership structure, and investor sentiment. The second point is all about the pricing. The offering price has been set at $5.57 per share. At this level, NIO is expected to raise around $1 billion. Now, some of you might recall that earlier estimates mentioned $1.1 billion, which created a bit of confusion. Here's why. When the offering was first introduced, the estimated value was indeed around $1.1 billion, but that figure was tied to market prices at the time. Since the actual offering was issued at a discount, something very common in these scenarios, the real number came down to slightly above $1 billion. The additional $12 million or so that seems to be floating in the calculations most likely accounts for bank fees, underwriting costs, and other associated expenses. This pricing decision might appear minor at first glance, but it reflects strategic intent. By offering shares at a slight discount, NIO makes it easier to attract institutional interest and ensure that the funding round is successful. Now, the third point tackles the big question: why is NIO raising funds now? A lot of investors were surprised by the timing. After all, the company isn't running out of money. They currently hold around $3.8 billion in reserves. So why the urgency? The answer lies in NIO China's ownership structure and contractual obligations. If we look back at the agreements tied to earlier financing deals, we see that NIO has a clause requiring it to contribute 20 billion RMB before the end of 2025. This clause effectively gives them until December 31, 2025, to fulfill that commitment. Missing that deadline isn't an option, so preparation has to start well in advance. Practically speaking, that means the contribution had to be arranged either in the third quarter or the fourth quarter of this year. Waiting until Q4 would be unnecessarily risky because markets can turn volatile, and year-end financials often complicate decision-making. By choosing Q3, NIO positions itself to meet obligations on time without facing unnecessary market or operational disruptions. The fourth point ties into another common question: why not hold off until NIO reaches profitability? Wouldn't it be better to show profits first and then raise funds at a higher valuation? On the surface, that sounds logical, but the reality is more complicated. To confirm profitability, NIO would need to publish official financial results. The earliest that could happen would be March 2026, when full-year 2025 earnings are reported. Waiting until then simply isn't an option if the contractual deadline for the 20 billion RMB contribution falls on December 31, 2025. In other words, they can't delay this capital raise until after proving profitability. The timeline doesn't allow it. The fifth point revolves around dilution. Anytime a company issues new shares, investors immediately worry about their stake being diluted. That's natural. But not all dilution is created equal. It's important to ask whether the dilution is happening from a position of weakness or a position of strength. When a company desperately needs cash just to stay afloat, dilution is usually a red flag. But in cases where the company is relatively healthy and still chooses to raise funds, it can signal long-term strength. That's what we're seeing here. The fact that NIO could close such a large offering so quickly shows strong demand and confidence from institutional investors. It demonstrates that NIO has the ability to raise capital without being in a crisis. Tesla provides a great historical example. Back in late 2020 or early 2021, Tesla issued a $5 billion offering, even though they didn't urgently need cash. The stock price rose afterwards because investors recognized it as a strategic move rather than a desperate one. NIO is aiming for a similar effect here, strengthening its balance sheet in advance rather than waiting until it's cornered. The sixth point requires us to look backward. While NIO has made impressive strategic moves, it hasn't always gotten funding decisions right. In fact, there are two moments that can be considered missed opportunities. The first was at the time of its IPO, when NIO only raised $1 billion. Compare that to Rivian, which raised a massive $11 billion during its IPO. That gap shows just how cautious or underprepared NIO was at the time. The second missed opportunity came during the Hong Kong listing. All three major Chinese EV makers NIO, XPeng, and Li Auto listed in Hong Kong. But while XPeng and Li Auto used that moment to raise significant amounts of capital, one of them raising around $1.5 billion, NIO didn't. Given the momentum and favorable market conditions back then, that was a big mistake. The positive takeaway, though, is that NIO seems to learn from its mistakes. More recently, it has shown much better judgment about when to use senior notes versus direct share offerings. This brings us to the seventh and final point, understanding why NIO chose a share offering this time instead of senior notes. In the past, when NIO's stock price was high, issuing senior notes made sense. A good example is the deal with Deutsche Bank, where NIO raised funds when the stock was trading at very strong levels. The bank had the option to convert at prices above $90, which seemed realistic at the time. But as the stock dropped, Deutsche Bank eventually had to unwind that position. While NIO had already secured funding at excellent terms, that was a smart move. But in today's environment, with NIO's stock at much lower levels, issuing senior notes would be dangerous. Imagine if the stock recovers to $30, $50, or even higher in the coming years. Any outstanding notes with conversion clauses would create massive dilution at those higher prices. By raising through shares now, at the current lower valuation, NIO protects itself from heavier dilution down the road. It's about managing long-term consequences rather than focusing only on short-term optics. So, to recap, NIO's recent share offering is about much more than just raising $1 billion. It's about fulfilling contractual obligations tied to NIO China, making a strategic decision in Q3 rather than waiting for Q4, and ensuring that dilution happens under favorable conditions. While some investors naturally worry about their stakes being diluted, the context matters. This is dilution from a position of strength, not weakness. NIO has made mistakes before when it comes to funding, but this time it appears to be taking a calculated, well-timed approach that balances immediate needs with long-term strategy. By choosing shares over senior notes, they avoid future headaches and preserve flexibility as the company grows. Ultimately, whether this decision turns out to be a turning point for the stock or just another step in NIO's journey will depend on execution, market conditions, and investor confidence. But one thing is clear, this isn't a move born out of desperation, it's a move made with foresight. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.